Hello everyone, I'm John with JP Strategic Investments, and today we're going to go over Patriot One Technologies earnings report that we just got yesterday. I'll go over all of the numbers, give my thoughts and analysis, and then we'll talk about what it means for the company and the stock going forward. So let's dive right in. So first of all, let's just quickly go over some of the business highlights that they mentioned in the beginning of the report. Most of you are probably already familiar with these if you're invested in the company, but just to mention some of the important ones here, we of course have the commercial release of the PAT scan multi-sensor gateway. We also have the naming of Peter Evans as the new CEO, which actually happened after the quarter had already ended, but they did include it here. And then we also have a note here about their ability to secure extra funding and cut unnecessary cost, which we'll get into later in the report. So next, if we just take a look at their financials here, this is basically their income statement. Now, I know I have a lot of viewers from Canada, especially for this stock, but for the bulk of my viewers in the US, just keep in mind that all of these numbers are in Canadian dollars, but it really doesn't matter too much because when you're comparing quarters to quarters, you don't have to do any conversions. So getting into these numbers, we can see that revenue actually did increase 223% year over year to just over $376,000. Now, on the surface, this looks really good, but this number is actually a little deceiving, and we'll get into that in just a second. Next, we have all the expenses related to the business, and finally, at the end, we have the comprehensive loss for the quarter, which was just over $3.3 million. Now, again, this seems pretty good as well, because a year ago in the same quarter, they lost over $7.3 million. Although, while this is somewhat of a positive, it's not quite as good as it seems. So let's dive a little deeper into the report here and get back to that revenue number. So first of all, while this is a good increase year over year, it's actually down from last quarter, which was about $385,000 in revenue. Also, if we look further down in the report, we can see that this revenue is solely due to the contract revenue from Extract, the company they acquired earlier this year. And while it is good to see that this acquisition is making them some money, it's still concerning that their main business still had no revenue in the quarter. Now, we can see here that they do have over $300,000 in deferred revenue for this quarter from early adopters of the PAT scan platform. So most likely this is deposits for customers who will eventually buy the product when it is finished. But if we look at the last quarter's deferred revenue, it's exactly the same. And so this revenue is not from this quarter. It's probably something that the company has had for several quarters now. So revenue was really not good for this quarter, but there is a little light at the end of the tunnel. We obviously had the announcement of the Plaza project in Las Vegas, so revenue from phase 1 and maybe phase 2 of that project should show up in the next quarter's revenue. And with sales and marketing just starting to ramp up, we should ideally see some more project announced soon. Keep in mind that Peter Evans has only just been appointed as CEO, so the next quarter's revenue is when we should start to really see what he can bring to the table as far as sales and marketing goes. Speaking of sales and marketing, it did seem odd to me at first that sales and marketing costs declined by almost 70% when product releases are just starting. But the company does explain this here, saying that the primary cause of this reduction in costs was a shift in marketing strategies and cancellations or postponements of different conferences and marketing events due to COVID-19. Another interesting thing that they add at the end of this here is that COVID-19 impacted travel for reseller onboarding, training, and early stage support on initial installs and client trials during the fiscal quarter. So this could be a potential positive here, as it could mean that there is some pent-up demand for the products that could just be delayed by COVID-19. I would take this with a grain of salt, but I just thought I would point it out as a possibility. Next up, we have research and development numbers, which were curiously low in this quarter, but there is also an explanation here. So the company did mention in the highlights at the beginning of the report that they secured extra funding for continued operations and research. Well, part of that money included $1.38 million in COVID relief from the Canadian government. This, along with the initial distributions from funding secured from the Canadian DTS, contributed to this decline in R&D costs. So after accounting for these costs, there was actually a 10% increase in R&D spending, resulting in a total of just over $1.67 million spent. Personally, I think this is not the right way to go about accounting for this aid because it distorts the company's financials, making it very hard to compare numbers over time. Instead, the company should just subtract the relief funding and grants as a separate line item in the income statement and show the true costs of R&D and other line items, so that investors and the company's own accountants can more easily analyze the company's growth and spending over time. Next, we have general and administrative costs. This one was actually a positive here because the company was able to reduce these costs by 9% by closing non-strategic offices. This shows the company is looking for ways to cut costs and make the business more efficient. Moving to the last main item here, personnel costs costs increased 24% in the quarter, although this number is also distorted because this is where the remainder of the COVID relief money was spent. After accounting for the COVID relief money, personnel spending actually increased 65%, which is a huge difference. Again, this is where I think it would be much better for the company to enter the actual number for the personnel spending line item and then on another line item show the relief money subtracted. It would offer a much better picture to somebody just looking at the financials. So the company does mention here, as expected, that this increase in personnel spending is mainly to prepare for the push into marketing and sales. So overall, these earnings were not great and honestly weren't put together very well. It doesn't help too that the company does not communicate with shareholders very well. We can see from the stock performance that most investors weren't impressed with these earnings, with the stock down over 15% in the last 2 days and approaching all-time lows. In general, these were not good earnings, but personally I'm willing to hold on and give Peter Evans a chance to show us exactly what he can do, especially once COVID-19 restrictions begin to go away. I hope you guys found this analysis helpful, and if you did, please consider liking and subscribing. And have a great day.